Welcome to the Chrisman Commentary, daily mortgage news podcast. I'm your host, Robbie Chrisman. Topics on today's episode include AI and regulation, my interview with Verisk's Kingsley Greenland on why an unusually active hurricane season may collide with weakening forecasting infrastructure, leadership gaps at FEMA, and political headwinds. And in the capital markets, there's a lot of news this week, but it hasn't really moved rates. Thank you to True and its Mortgage Operations Service, or MOS platform, which transforms borrower documents into instant, trustworthy data for real-time decisioning. True cuts time to critical loan events from days to minutes by using background AI workers to instantly validate data and automate underwriting decisions. Happy 50th birthday to the movie Jaws. Back then, for security, I think all people had to remember was their house key or the combo to the lock on their school locker. Now, logins and passwords are regularly either forgotten or stolen. The latest being 16 billion credentials stolen announced this week, in what people are calling the largest hack of consumer information ever. My dad loves that type of stuff. Speaking of IT, there have been a few CIOs that have written in to point out that Trump's One Big Beautiful Bill Act that the Senate is debating contains a 10-year moratorium on changes to state artificial intelligence laws. 10 years? Given the rate of change, how about 10 days? The technology used to collect pay stubs has certainly changed over the years, but what is the definition of a pay stub? It turns out the answer is not so simple, and it varies by state. It doesn't help matters when there are dozens of companies that help individuals write their own pay stub, aka forge for whatever purpose. Hence the rise of verification services. But let's get to the big news of the week. Or lack of news, I guess. As was universally expected, the Federal Open Market Committee on Wednesday held the federal funds target unchanged at a rate of 4.25 to 4.50%. This marks 6 months of no rate changes after the FOMC cut the target a full percentage point between September and December 2024. Fed Chair Powell warned that tariff-driven economic uncertainty and inflation risk continue to complicate the central bank's bid to ease monetary policy in earnest. However, updated projections revealed a more cautious stance amid rising economic uncertainty. The Fed chair reinforced that the Fed needs more clarity before acting, especially on the inflationary impact of the recent tariff hikes. He pointed out that although the current labor market and inflation levels look relatively healthy, future risks from trade policy and geopolitical conflict could push inflation higher and weaken job growth. These stagflation-like threats are difficult for the Fed to counter effectively. Powell stressed that while the economy gives the Fed the luxury of patience, the costs of tariffs will eventually be passed along to consumers, adding to inflation pressures. For today's interview, I want to welcome back to the show Verisk's Kingsley Greenland to talk about why an unusually active hurricane season may collide with weakening forecasting infrastructure, leadership gaps at FEMA, and political headwinds. He's Director of Mortgage Risk Analytics at Verisk Extreme Event Solutions, and he's held various roles in real estate finance covering origination, servicing, private equity, and valuation. His subject matter expertise is in climate risk, stress testing, catastrophe modeling, and insurance.
I was actually in Florida last week for NBA Florida conference, but I spent a couple days before that in the Florida Keys in Miami, and I swam in the ocean. Felt like a bath, which I'm not complaining. I liked it a lot, believe it or not. It felt great. I didn't want to get out. You feel like you're it's relaxing. I liked it. But as I learned in my AP environmental science class in high school, warm air, holds more moisture than cold air. And so I say that because of hurricane season. And Florida, obviously climate models this year are projecting an unusually active hurricane season, largely due to hotter ocean temperatures. Let's talk data here before we turn people off politically, and we will never go off politically on this podcast. Can you walk people through what the data is telling us? I think we still believe in data in America, and how confident we should be in these projections. Maybe we don't believe in data in America, but go on.
Pause for a minute. So you triggered some idea with this moisture retention. There is an often cited rule in flood modeling and hazard risk that 1 degree increase in temperature leads to a 7% increase in water retention in the air. So you'll see some of those linked to climate-related projections of temp and say, therefore, we're going to have this much more flooding. But that's not perfect, because just water retention, the ability of that moisture to be in the air, does not necessarily mean it's going to fall down and cause flooding. And it feels similar when I read and think about sea surface temperature and hurricane formation. Yes, it does provide a context for more severe storms, but there's no guarantee that just because all the ingredients are there, that will manifest in a hurricane, much less a severe landfalling hurricane. There's some numbers that come to mind. It feels like about every year we have something like 15 to 20 big storms that cook up out in the distant ocean, and only 1, 2, hopefully sometimes 0 of those actually make impact and become real issues for banks and borrowers. So confidence in the forecast, well, directionally, I think it's pretty fair, because you're pulling those from historic data. You say these are the warm years in the past. We see these clearly. It had worse outcomes for hurricane formation. We have another warm year cooking up. Therefore, the risk is higher.
Now that we weren't political for one question, let's get political here. There are staffing shortages at the National Weather Service. There are fewer weather balloons being launched. Can you talk about how this impacts the accuracy of models that you and others rely on? Maybe we'll keep it, obviously at the end of the day, if investors in the mortgage space care about this and it impacts pricing, we all should care about it. But also implications for public safety if we're getting rid of scientists and weather balloons. I tried to argue to my dad that maybe modeling can replace some of these middling scientists out there, and we don't need quite so many scientists. We don't need so many weather balloons. True or false?
Well, I hope that's true, since
me too.
The data that we have is that we have fewer scientists, fewer resources going toward these issues. So it would be a positive thing if that were somehow linked to less need for more people looking at the same thing. We hear that elsewhere in AI. We hear that in mortgage. Like, I'm not hiring more underwriters and processors because I think I can automate it. Can we extend that same optimism to these large organizations that had staffing cuts? And those staffing cuts, at least in principle, seemed to be folks that were working on politicized issues. Like climate was the big one. You can't say climate. We had full climate teams that were laid off at NOAA and FEMA. So do I like to see that as someone who's working in a climate adjacent role? No. But I don't know these people. I don't know what projects they were working on, or if it's something that, well, I think you get that sentiment, right? Just the limited information that we get by way of headlines. Your existing biases and how you feel about the issue are going to determine where you land on the severity. Like if I'm thinking about climate every day and whatever it takes to get to net zero and become more resilient, then I want as many people as we can find working on that. If I have a bias toward handling things at the state level, toward a smaller government, more distant things, then I see cuts to an organization I've never heard of and think, well, great, we're going in the right direction. I can tell you as a consumer, I still get my weather every day, and I find it hard to believe that even with some level of cutting to the budget, that we would somehow be flying blind into major storms. There's just too many eyeballs outside of FEMA and NOAA trying to look at this that I don't see it going back to call it the pre-tech era, where natural hazards were much more severe, much more damaging, because you had no idea. I mean, you could think back to like a ship at sea without radar. Those problems don't exist now because you have visibility. And I think even if you don't have the weather balloons, you're still going to have satellite. You're still going to have rapid communication among people. So I think the response, call it ceteris paribus, is still 21st century reaction once the event is formed.
Well, it's comforting, and it's own way.
I hope I'm right.
Yeah, I hope you're right too. Honestly, nobody wants
Yeah.
nobody wants more damage and destruction from
Right.
These climate related
Right.
disasters. We are entering hurricane season, which I need to admonish my friend that booked a bachelor party in Key West in mid to late August. So we'll see how that goes.
Yeah.
But any concerns you have now that we're seeing less coordination out there between modelers, forecasters, emergency managers? And I say all this with obviously it seems like there's kind of unpreparedness at FEMA, at least reportedly, or at the very least leadership turmoil there.
These groups were underfunded in the first place, and I question the extent of like some super efficient coordination in the first place. They're disjointed. They have trouble. You look at a big business, you have trouble working between divisions. So how much coordination could you expect between national orgs in the first place? But I've heard a lot of concern about access to data sets, that the data is not going to get where it needs at the right time. But again, when I have those conversations, it's more like a feel, not this data set that I relied on to quantify models is no longer available in its current form. The closest we've seen to that was the disaster database from NOAA. I think that was, I've used it as a slide before. It was pretty cool information, pretty cool data. But outside of nerdy curiosity and consumer interest, that stuff already happened. That wasn't something that, if I didn't know the damage estimate of Katrina, would it make me any less resilient for this hurricane season? Optimistically, I hope not, but a little bit of pleading ignorance. Like, there are just so many moving pieces that I can't identify any one thing where I say, well, they cut this or these guardrails are up, so therefore we're going to have worse outcomes for this hurricane season.
Let's talk kind of in a practical sense here. It
Yep.
seems like federal investment in climate infrastructure, like forecasting and disaster responses, is receding. In this current political environment. Obviously, you said there's a lot of eyeballs still out there, but when you look at what's going on from a government perspective, are we undermining our own climate resilience in a way by, and obviously, like I said, I don't want to come at it from a political angle, but maybe it was cutting some of the excess fat that we didn't need in the first place, or maybe we are positioning ourselves to fly blind. I'm not sure. You're the expert. Do you feel like we're undermining our own climate resilience with some of the stuff that's gone on?
We could be, to the extent that if you attach politics to a certain data set or a certain discipline, being like climate modeling or catastrophe modeling, calling it climate physical risk, you could have less funding. You could have, let's look at the agencies. They had, if you look at FHFA, laser focused on everything climate by way of policy during the Biden admin. And then just in a matter of days, you retroactively changed the name of climate conferences that I attended, now called natural disaster conferences. It's a little weird. We were all there. We knew it was a climate conference. But now we see that it's called something different. The optimism in that is that in calling things climate, people weren't looking at earthquake the way they should have been, because earthquake is not a climate-driven hazard. So maybe it's a broader brush. Maybe we do more for natural hazard risk in near present instead of looking strictly forward on what may happen in 2050. We could have a more refined focus on just exogenous shocks from weather or from earthquakes and go in that direction. But I think that because you've framed it, not you, just the public discourse, is like something that's so binary. Either you're concerned about climate related issues or you're not. Yeah, obviously you're not going to get this whole of society response that you'd have a potential to if you say, well, what can we pull out of this? And the thing that may have been successfully pulled out of all these conversations about climate risk is that it's kind of been around for a long time, just under a different name, being natural disaster. So if we can go on the right and call it natural disaster risk, and then just kind of tolerate on the left that we're talking about the same thing, we could still move forward and try to become more resilient as a society.
Yeah, I do think that that's very sage advice there. There's no reason for this to be political. Nobody wants their house to get destroyed in a wildfire or a hurricane. And if we can be better about uh, preventing that or preventing loss of human life, I think that's a good place for society to go rather than digging our heel. You're looking off into the distance, like I said, something controversial there.
Because there are policy implications. Like if you put the politicians off to the side and say, what is the policy? Then you get into budgets and trade-offs, which is why people have different opinions on it. Meaning, if we've identified hurricane risk as being a problem for Florida, but not for Montana, of course it's always going to be politicized if you're asking folks in Montana to do more for folks in Florida. Therefore, there's the case that something like a nationwide response to either climate or natural hazard, it's always going to kind of take from one group and give to another. So if you put it down to the states, then those are the people that are benefiting. Those are the people with best information. I understand that impetus. And yet, if you were to ask even the most minimalist, like I like my government small and silent, if you were to go with that bias, those people would still probably say that natural disaster response is a core competency and something that a government should be doing. They'll rattle off 10 things, and then that one is going to make the cut for a bare bones budget. Like, what does government exist for? Probably helping the citizens after some severe event hits them that they didn't have any control over.
It is funny. Whenever I have someone on this podcast championing national insurance, whatever it might be, it seems like
Sure,
they're
yeah.
from Louisiana or Florida or somewhere else.
So
They're not
goes,
quite
yeah.
from Idaho or Montana or
Yeah.
Utah. So it's certainly an interesting point there. Let's close with this. And I've certainly enjoyed this interview, and I appreciate you indulging me in some of these discussion topics, even if I came at it from a lighthearted angle when it isn't really. Uh, but from a modeler's perspective, any blind spots that you're most worried about? And I guess what should the public and policymakers in a utopian world, what should the public and policymakers be focused on?
I think that in the US, they were in the right direction by asking banks and investors to not only model the impact of hypothetical or synthetic events, bad hurricanes in the Northeast, wildfires in California, but also asking to test their dependence on insurance support. Because those are two different things. If a bank looks at their historic data of all of the natural hazards that they've already experienced, if they have that in their data set, they'll find they didn't lose all that much money, if anything, because they had insurance support. Yet the insurance industry has been very vocal about how current trends, there are likely properties that would be difficult to insure, particularly at an affordable rate. So I don't see as much inertia as we had a few years ago in trying to merge these two disciplines together of like modeling the risk and trying to find out how dependent that is on insurance. And I expect that issue to continue because there is the insurance data that a curious analyst would want to properly quantify the dependence on the insurance support assumption. It doesn't exist. We had government organizations try to do these data calls, try to find. We got some data, but it was from like 2018 to 2022. So we still don't have access to that coverage data that we would really need at a portfolio level to get a true sense of natural hazard risk against various insurance support assumptions. We have to model it.
I guess before I let you go here, Seems like you're always doing traveling. It seems like I always wait too long to have you back on the show. What have
Yes.
you been working on recently? Anything you find really interesting that you think would be worth sharing with listeners?
Yeah, so the modeled approach to finding different ways to quantify what insurance premiums might be in the future, or what insights we can make in absence of correct data. So like zip code level inferences on deductibles, insurance limits and premiums. I've found those are really helpful for banks. There are also some imprecise, imperfect ways to forecast premiums if you have a forward-looking view of the hazard, like just take the ratio of your average loss to the rate you pay today, hold that constant, forecast the hazard, and then you have some kind of similar ratio idea of premiums. But I've spent a lot of time looking outside the US since we last talked because things have, from a policy perspective, slowed down. So I think that years from now, we'll still be able to piggyback on the advancements in climate risk management and analytics that we're seeing in the UK, in Toronto, Australia, Malaysia. A lot of great countries are still moving forward. And I don't think there's any reason why we can't just cherry pick. It's kind of the American way, right? Just look at other countries, say, what do we like, bring them in here, and maybe catch up down the road.
Very nice. I hope that wasn't a pun that, tomato ketchup was actually invented in a different country and we brought it here. But anyways, always a pleasure talking to you. What do I know? Always a pleasure talking to you. I appreciate the insights, and I look forward to having you back on the show. We
Sweet.
will.
I don't think you're going to find much sympathy for government layoffs within mortgage banks. I mean, people have been getting slashed unceremoniously since 2022.
That's a very good point.
They got into like, cry me a river, like a couple of scientists have to go to university.
It's I forget what movie it's from. Might be The Ballad of Buster Scruggs, but James Franco's getting hung.
Yeah.
Like got out of it one time and he's back and some guy's like crying next to him. He looks over and goes, "First time?" It's like in the mortgage industry, like, "Oh, you're getting fired?" Yeah, first time. Wow, tough.
Yeah.
But I appreciate you making the time.
All right, Robbie. I'll see you somewhere sometime soon.
Yeah, looking forward to it.
Yep. Take care.
Futures traders are increasingly betting that the Fed will become more dovish, possibly after Powell's term ends in mid-2026, but are still pricing in nearly 50 basis points of rate cuts this year. Some argue that the Fed is simply aligning its forecasts with market expectations, using the dot plot as a communication tool rather than a policy commitment. But the market's faith in the Fed's steady hand approach may waver if the economic fallout from tariffs and conflict proves more severe than projected. While investors pore over every word from the FOMC, it's clear that the real drivers of rate policy may lie outside the Fed's control. And from the bad news department, residential construction is slowing down as builders and developers face high borrowing costs, ongoing economic uncertainty, and tough supply conditions. In May, housing starts dropped 9.8%, mostly due to a steep decline in apartment and condo projects, which tend to fluctuate more. Single-family home construction inched up a bit, but overall building activity fell to an annual pace of 1.26 million units, the lowest level since the height of the pandemic in 2020. On top of that, fewer building permits and declining builder confidence point to more weakness ahead. While home building has held up surprisingly well despite years of high interest rates, it now seems that those rates are finally starting to slow things down more noticeably. Following yesterday's Juneteenth holiday, markets returned today to an economic calendar that was kicked off by Philadelphia Fed manufacturing, and later today brings leading indicators for May. It's worth noting that after the Fed's decision to keep interest rates unchanged, surprising no one and angering President Trump, yesterday the Bank of England also held its key rate. The Swiss National Bank lowered its benchmark rate to 0 and signaled it's ready to go deeper to protect the franc, and Norway's Norges Bank surprisingly cut borrowing costs too. Yesterday's market holiday and what's sure to be a light-attended session today imply that the post-Fed reaction should set a tone that will carry into early next week, barring more dramatic news in the Middle East. Monday, the 2-year was yielding 3.97, the 10-year was at 4.44, and we begin today with the 2-year at 3.96 and the 10-year yielding 4.42. Agency MBS prices are a little changed from the last trading day as well. Let's wrap up with a joke and some housekeeping. A turtle is crossing the road when he's mugged by 2 snails. When the police show up, they ask him what happened, and the shaken turtle replies, "I don't know. It all happened so fast." Thanks again to True and its mortgage operations service, AI Background Worker, which transforms borrower documents into instant, trustworthy data for real-time decisioning. True cuts time to critical loan events from days to minutes by using background AI workers to instantly validate data and automate underwriting decisions.